It's all about OPEC Plus now, the global oil market. We see they've postponed the ministerial meeting scheduled for the 30th of November, leading to speculation that producers might cut output less than earlier anticipated. Joining us now for that conversation is Dr. Desola Simoni, Senior Analyst, Financial Derivatives Company. Great to have you on the show. Good morning.
Good morning, Ladi. Thank you for having me on the show.
Fantastic. So right now we're seeing a lot of volatility in the oil market at this time. What scenarios can we expect going forward with the postponement of this meeting? It seems it's meeting postponement season. We had that postponement there for the MPC meeting we're supposed to have this week.
Indeed, Ladi, indeed. So regarding OPEC, one factor that markets do not like is uncertainty, right? And so with the postponement of the meeting from November 26th to 30th, it brought some uncertainty into the market, and that's why we saw oil prices decline quite sharply. Brent was down 1%, WTI was also down. And the markets were looking forward to the meeting to get some form of direction about, about OPEC's plan in terms of production cuts going forward. Already we know that the production cuts for this year are going to last until the end of the year. We know that for sure. But going forward, the markets were looking for direction or some form of signal from OPEC on, whether they're going to extend the cuts, whether they're going to cut deeper, etc. Now, there's some analysis coming out of the market that shows that the market will be oversupplied next year and OPEC will need to cut deeper. So part of the reason for the postponement, according to sources close to the case, was because there was no consensus about, who's going to take the cut. So OPEC Plus also agrees that there might be a need to cut deeper, right? But how are they going to share the cuts? Those are some of the issues that led to the postponement. Also, some countries were not keeping up with their production quotas. Some countries were overproducing, therefore oversupplying the market and reducing the impact of the production cuts. So those are some of the issues that were discussed.
Do you think the members at this time will be able to agree to some kind of cut, going forward, or do you see them towing the path of every man for himself?
So at the end of the day, Ladi, so Saudi Arabia is the de facto leader of OPEC, right? And even though these production cuts are not legally binding, Saudi Arabia has a way to kind of ensure compliance, because Saudi Arabia can choose to flood the markets, right, with oil, and the cost of production for Saudi Arabia is one of the lowest across OPEC. So Saudi Arabia can afford to be a loss leader in the sense that they can flood the market and make it bad for everyone, but they are still able to break even because their cost of production is quite lower. So they are considering that, but hopefully other countries can agree to some form of production cut. Last time, as Russia agreed to, reduce its exports by around 300,000 barrels a day, Saudi Arabia also led the cuts by, taking in an additional 1 million barrels a day. There are talks that they are expected to deepen the cuts by around 1 million barrels. But if you look at a country like Nigeria, for example, even though our production target or quota was around, I think, 1.8 barrels a day, or 1.6, I don't remember the exact number, Nigeria is still not even producing close to that. Nigeria's production, I think, is about 1.3, 1.4. So in agreeing the new cuts, I think there will still be some wiggle room for countries who are having some problems with their production, like Nigeria.
Talking about Nigeria this time, we're definitely aiming for about 2 million barrels, going forward. How does this impact our output forecast? Because we're trying to get it up at this time. We're trying to get more revenue. How does this impact that dream at this point?
Indeed, Ladi, if Nigeria can produce 2 million barrels a day, that would be excellent. The last time they've produced that, I think, it's been many, many years ago, because we keep having these attacks on oil infrastructure. We keep having oil theft and etc. So at the end of the day, right, there's a trade-off, right? So if Nigeria violates their production quota, for example, then the prices are going to drop down. So it's going to be a trade-off between, higher prices and lower production, or higher production and lower prices. And I think Nigeria's outputs, Nigeria's revenues, I think they are more elastic, sensitive to higher production. So Nigeria would probably have to strike a deal with OPEC about a production level that is high enough, but that is still kind of reduces supply in the market so that we can enjoy both a reasonably high price and a reasonably high output.
All right, with what you've seen so far in the market, do you think OPEC Plus are going to come to some kind of agreement soon?
Indeed, because Nigeria's production has been lagging quite significantly, right? Since I think 2 years ago when OPEC came up with this production cuts, Nigeria has not been able to produce enough, up to even 1.6 million, 1.7 million barrels a day. If you look at the reports, monthly reports from OPEC, which we track on a regular basis, you see Nigeria's production going from 1 million barrel, 1.1 million barrel, 1.2 million barrels, sometimes was even less than 1 million barrels a day. So I think OPEC is going to give some form of wiggle room for countries like Nigeria who have not been able to increase their production so far in deciding these new production cuts going forward.
All right, what are you seeing for prices by the end of this year?
I think prices are still going to remain elevated. Prices are going to be determined by, the outcome of these OPEC meetings, but also geopolitical conflict. These days, geopolitical conflicts are having big effects on commodity prices. So geopolitical conflict is going to be a big factor affecting oil prices. Thankfully, now we have some ceasefire between Israel and Hamas war and the Ukrainian war as well. But apart from geopolitical conflict, OPEC, how deep they are going to cut is going to drive prices going forward. Also, we're looking at demand. 2 weeks ago, OPEC revised upwards their oil demand outlook for this year, and that's also expected to affect oil prices going forward. But we are still not seeing strong demand coming out of Asia, China, and Japan. Their economies are not growing as quick as we'd like, and as a result, the prospect of higher oil demand coming out of that region is not materializing yet.
All right, let's take a look at LNG now, liquefied natural gas. It's down about 0.07%, but I've seen that this LNG has not recovered, ever since, hitting the high, during the peak of the Russia-Ukraine war, Russia turning off the taps of gas to Europe. It's still below $3 at this point. Why hasn't it recovered like we've seen with oil?
Two reasons. Number one is the weather, right? So we've seen last year we had a warmer than expected winter. So as a result, the demand for heating, the demand for natural gas for heating was relatively low compared to like the 10-year average. And because of that, the storage of natural gas was also high. Currently now, at the moment, the storage of natural gas in Europe is around 99.6% full, which is unusual for this time of the year. Also, we are having a warmer than expected autumn. At this time of the year, the temperature is warmer than it typically is. Many people have not even turned on their heating yet. So there's across Europe there's lower demand for heating. We have ample storage. We're also still receiving a lot of imports from North America, particularly the United States and Canada. So those factors are why we've still not seen natural gas prices recover. I think going forward, there are talks that a colder than expected winter may affect natural gas prices, but there's some analysis that shows that even if we have a colder than expected winter, at the end of the winter period, the natural gas storage will still be around 30% full, which is still higher than the 10-year average. So I think at the moment, Europe is in a safe space, but there are still some risks in terms of the natural gas supply.
All right, in the grains market, back in the news at this time, Russia and the Ukraine war still impacting that market, but we're seeing wheat inching higher at this time. Are we seeing some kind of rally coming there?
No, indeed. What happened? What is happening is that we are still seeing some Russian attacks on Ukrainian grain infrastructure, and we know both Russia and Ukraine are huge producers of grains, both wheat, corn, etc. So already that prices in that region is driving commodity prices, and it has a wide range of implications. But quite recently, we saw Russia attack grain infrastructure in Ukraine, and that kind of created some concerns around the supply of of grain to the market. In addition to that, it also created concerns about international trade and the global supply chain of the grain. So those factors and the uncertainty surrounding those factors are why we are seeing our grain prices trend upwards. Also remember that the Black Sea deal was also not renewed. So the disruption in supply chain coming out of the region, the disruption in international trade, as well as the attacks on grain infrastructure in Ukraine, those key factors are still going to keep driving wheat prices going forward.
All right, let's get a check on the FX market. Now, we're seeing pressure in the parallel market, 1,158 yesterday. What's driving sentiment there? Is there no supply again at this time?
So the market wants some direction, right? At the moment, for example, look, we are supposed to have the monetary policy meeting this week. That did not happen, and that's just creating some form of uncertainty. Even though we've gotten some comments from the central bank saying they're trying to clear backlogs. We're expecting some inflows from the Middle East. We're expecting some both FPI and foreign direct investment. Even though the central bank has allowed the interest rates or the stock rate of treasury bills or OMO to trend upwards quite significantly. For a 365-day bill, for example, you can get it for 17 to 18%, which is positive. Even though all of that is happening, I think there's still some form of uncertainty in terms of the policy direction. We've still not had any solid statement from the central bank governor, and that is kind of still making the markets a bit anxious. Investors are still adopting a wait and see approach to see what's the direction going to be. But I think that the market would I think towards the end of the year, I think we're going to see the exchange rate appreciate. We're going to see the exchange rate appreciate. I don't want to give a number. I think we're expecting some inflows towards the Christmas. I think there's going to be a lot of remittances into the country. Last year, remittances were put in at around $20 billion. So a lot of relatives abroad are going to send money back home over the Christmas holidays. Some of them are also going to visit. They're also going to visit the country back, bringing in some hard currency, and also they're going to take advantage of the weaker currency to invest in Nigeria, whether to invest in agriculture, invest in real estate, invest in the stock market, or even in the fixed income market. So all of those factors, I think, would allow the currency to appreciate towards the end of the year.
All right, I guess we'll be expecting the I just got back people soon. Thank you so much for your perspective. This was last morning, senior analyst, financial derivatives company. Thank you.